Quantitative easing is coming in 2020. Let's have a look. Hello everyone, Florian Heise here and welcome to another episode of Heise Says. I thought we'd have a look at this article. This is to do with 2020 could be the year Australia joins the QE club. And it's an explanation of what quantitative easing is. Now, for those of you that do not remember, our Reserve Bank governor suggested, or pretty much promised us quantitative easing when Australia hits a cash rate of 0.25. At the moment, as you can see on this chart, we're at 0.75. That means we're effectively 2 cuts away from the potential of QE. So let's learn a bit more about what the ABC is telling us QE is. So, try bringing up quantitative easing at a dinner party and see how long you can hold your friend's attention. I'm sure you could hold it with a lot of people's attention. I guess maybe I'm bringing it up with people at the shops when I'm going out shopping, at least the cash ban. Known in financial circles as QE, it's a conversation stopper because it's complex and hard to explain to people outside financial circles. Even many people in financial circles don't really get it. Now, it's just a new way of saying money printing. Strategic purchasing of particular assets is only going to help certain classes of the economy, and certain portions of people will get the major benefit from the first spending of the money before inflation screws the rest of us plebs. Seems pretty simple to me. But it's worth understanding because if the RBA uses it next year, it will affect most, I'd say all Australians. Without going into the confusing technicalities, all you need to know is that it will involve the Reserve Bank, Australia's bank to the banks, using its own cash to buy bonds, probably mainly government bonds. Given that the Reserve Bank literally prints Australia's money, it has a theoretical endless supply. Oh, that shows a lack of understanding of how loans are actually... The private banks are generating money, but that's not for this topic. The more the RBA buys bonds, the more the price of those bonds will rise. Interest rates on bonds move in the opposite direction of their price. That means as bond prices rise, their interest rates fall. The effect of this is that interest rates right across the economy, from mortgages to corporate bonds, all fall, because changing the interest rate on government bonds has a ripple effect through the money or bond markets. If the Reserve Bank wants to especially target particular areas, like say home loans, then it could buy bonds directly in that sector to push mortgage rates down even lower. Where's the mention of this affecting inflation and the purchasing power of our economy? Hasn't mentioned that yet, has he? So why do QE? Because you're out. Because the system they've got is kind of failing. So what's the point of all this then? The problem facing policymakers is that the economy is slowing so much that workers are starting to lose their jobs. And once those positions are gone, it becomes increasingly hard to land new ones. Well, let's have a look at a few things. The building sector, we know, is going down, guys. Foreign investment has plunged. Wage growth is non-existent. GDP is heading down. So, yeah. Sure. In the past, dropping interest rates has been a great way to stimulate the economy. Unfortunately, interest rates are already very low, a legacy of the global financial crisis. And the Australian economy has been depressed since the global financial crisis. We're about 10% smaller than we should have been. On a per capita basis, we're doing pretty bad, to be honest. The cash rate currently sits at 0.75%. This means the Reserve Bank can probably only cut interest rates twice, once by 0.25 percentage points to 0.5, then another 0.25 points to 0.25. That's the level the Reserve Bank says it will consider rolling out unconventional monetary policy, also known as QE. Our current thinking is that QE becomes an option to be considered at a cash rate of 0.2%, but not before that, the RBA's governor, Philip Lowe, recently remarked. At a cash rate of 0.25%, the interest rate paid on surplus balances at the Reserve Bank would already be at zero, given the corridor system we operate. So from that perspective, we would at that point be dealing with zero interest rates. The bottom line is that the Reserve Bank needs to keep providing stimulus to the economy in the hopes that finding a job becomes a little easier. That way shoppers will likely have more confidence to spend in the sector. Well, consumer confidence isn't doing too well. I would argue that, we'll just bring up here, these cash rate drops that we've had recently have had an effect on consumer confidence. Now, if the Reserve Bank cut the rate another two times, and we started hearing about QE, what do you think that would do to consumer confidence? What do you think that would do to business confidence? If the purchasing power of your money just starts getting whittled away more and more and more. Let me know what you think in the comments, guys. So, what's in it for me? Some economists are forecasting that there will be interest rate cuts in February, then again in May, with QE to be rolled out by the end of next year. The best case scenario is that once this has all been implemented, if it is implemented, your mortgage could be significantly cheaper to service. Comsec estimates that over the next year to September, the average family was able to save roughly $24 a week compared with a year earlier as a result of tax and interest rate cuts. And I mean, that in some ways that is a good thing, because I'll bring up the arrears rates here. You can see how they've steadily climbed. Look at the number of houses or mortgages that are over 150 days late, particularly in Western Australia, guys. That's not looking good if you're in that situation. So, with 2 more interest rate cuts and QE, this saving could more than double. And what do you think will happen? I can guarantee you what would happen to most people. They'll just attack their loan. They'll attack their loan. Because you know why? We've had enough. People have had enough. They can't be bothered anymore. Let's go kill ourselves and work in debt slavery to buy shit we don't need, really. Pay off the debt, get out of it, and then live a simpler life. It's much happier. Much happier. Maybe that's just me. Maybe I'm just getting older and wiser. Yeah, let's hope that. As for those in the jobless queue, well, it should also become easier for businesses to borrow. Most businesses choose to hire when they've invested in a new project. So the more they're investing and growing, the more there'll be demand for new hires. The problem is, if this kind of logic hasn't worked to date, why would it suddenly change now? Well, yes, it hasn't. It hasn't worked in Japan. It hasn't worked in Europe. The ECB, the central bank in Europe, has pretty much guaranteed QE forever. This is just the journey. This is just the start of this fiat currency losing its intrinsic value. Has that happened before in history? I'm trying to think. Has it happened before in history? Let me know in the comments, guys, if it has. Some economists are warning the opposite of the above will prove correct, and that the stimulus won't work, that businesses will continue to pull back on their spending and more jobs will go. Next year is shaping up to be an important one for the economy. So let's have a look at a little bit more data. I mean, we can see the cash rate, how it's gone down. We can look at wage growth in the private sector compared to the public sector. Look at that difference there. It's the bottom 2 lines there. Most of the growth has been in the public sector, and they're not aligned. One thing that's interesting with the jobs data that came out today from the United States, guys, they had the US data coming out, and a big portion of that was from the public sector, that jobs data. A big portion of that jobs data from the United States was from the public sector. So that's interesting. They're having similar issues to what we're having here in Australia. And we've got, guys, we've got the wage growth. Well, we're all clearly familiar with that chart from the RBA now. So how do you think it's all going to end? Where do you think it will head, guys? I mean, the key points: quantitative easing or QE is a large last-ditch way for central banks to boost the economy when interest rates are near zero. Central banks buy bonds, which pushes the interest rates down, filtering through to mortgages and other loans. Economists are divided about whether the Reserve Bank will need to undertake QE in Australia and whether it will even work. Well, I would argue just look at Japan. Just look at Japan. So guys, let me know what you think. Do you think this will be the fantastic finish for next year, or is it going to be a start of tougher times in the Australian economy? Let me know in the comments below. Thank you for watching. Please like, share and subscribe to the channel. If you enjoy the content and want to help us produce more, we have a Patreon where you can make a small monthly donation. We also have PayPal where you can make a regular donation. We have merch on the Heise Says website and Amazon and eBay affiliate links. Appreciate all your help and support, everyone. Have a great day, and I will talk to you later. Bye for now.